Hello and welcome to the Business Standard Morning Show. I am Ruchika Chitravanshi. It is 3rd of January 2024 and here are the questions we will be answering today. Will 2024 bring relief for Apple? What is driving increased Indian FDI into Dubai? Will large cap MFs find their mojo back in 2024? And what is the Eurasian Economic Union? "2023 made a dent in Apple's global business. The company not just ceded the top spot to its rival Samsung, but also posted its 4th straight quarter of revenue decline on a yearly basis. It was the longest slump for the US firm in 2 decades. And not just this, the tech giant also faced the wrath of regulators in China, US, and European Union. So will 2024 give some breather to Apple? Shivam Tyagi finds out.
Apple faced a multitude of challenges in 2023. The latest being a ban by the US International Trade Commission or USITC on Apple Watch Series 9 and Apple Watch Ultra 2 over patent row. But the ban was lifted after the firm filed an emergency appeal with authorities. Although the Cupertino-based tech giant may have got a temporary relief for its smartwatches, the regulatory hurdles do not stop there. European regulators pushed back against Apple's product policies in 2023, forcing Apple to accept the new regulatory norms in the region. Apple heeded to EU's request and replaced the Lightning cable with a universal charging cable of USB Type-C on the iPhone. However, the EU is now pressing for further changes, specifically urging Apple to open up its ecosystem to competitors. The EU's guidelines include permitting users to uninstall pre-installed apps and replace them with third-party alternatives. Reportedly, the Indian and Japanese governments too are working on bringing in similar regulations on the tech giant in 2024. The Indian government is pushing Apple to replace its Lightning cable to USB Type-C. Apple, however, has asked Indian officials to exempt it from the rules, saying these may hinder its production targets. These targets are set under the government's product-linked incentive scheme for mobile phones, which Apple is a part of. Apart from regulations, the company also saw its revenue dipping year-on-year in all the 4 quarters of financial year 2023. Apart from regulations, the company also saw its revenue dipping year-on-year in all the 4 quarters of financial year 2023. The company's fiscal year begins in October and ends in September the following year. In the 4th quarter of FY23, Apple's revenue was down by 1% year-on-year, continuing the full-year trend, while the sales of Mac, iPad, and wearables also declined. Sale of Apple's Mac was down by 33.9%. In the September quarter of 2024, iPad sales were down by 9.8%, while that of wearables dipped by 3.1%. Apple's woes did not end there. Its second biggest market, China, also faced turbulence. In September 2023, Beijing banned iPhones for state agencies and state-owned companies. Chinese regulators have launched an investigation into Apple's key supplier Foxconn over taxes and land use. In response to this, Apple is actively diversifying its supply chain with increasing its manufacturing in India, a market which is in the bright spot for the tech giant. According to company research platform Toffler, Apple's India business reported a 48% surge in FY23, while its net profit increased by a whopping 77%. The company is in talks with the Karnataka-based Acus Group and Foxconn subsidiary Rapris Technologies to scale up manufacturing in the country. In 2023, Apple fans in India got a huge present from Tim Cook, Chief Executive Officer, as he inaugurated the first 2 exclusive Apple retail stores in Mumbai and New Delhi.
India is for Apple what China was in the last decade. India will power Apple's growth story in this decade. There has been a strong growth momentum that Apple has witnessed in India. And this has been primarily contributed by a growing Make in India, a growing presence of supplier base for Apple in the market, for not just its attractive domestic market, but as well as for India as an export base. If you were to look at Apple's play in India, there has been a very strong, aggressive retail rollout, both online and offline, contributing to Apple's success, not just in tier one cities, but across aspirational India. And this has contributed to Apple's highest ever market share in India at 6% this year, and it could potentially reach 8% in 2024.
According to reports, in 2024, Apple is expected to globally launch the new iPhone 16 series, M3 MacBook Air, Apple Watch X, and Apple's first ever virtual reality headset, Vision Pro.
I think as is expected, 2024 will be, the Vision Pro will be the device to watch out for. That is, the global launch is in 2024. For other devices, I am seeing a lot of kind of, stagnation, or in other words, we may say maturity. But then we would now want to see in 2024 how Apple leverages AI on device, or on-device AI, which we call, because others have already launched chipsets, though Apple has been using neural network for some time now, but as such, it has never come up with that it is leveraging AI on device. Okay, so that would be another interesting thing to check in 2024, which can span across devices. For instance, iPhone, or maybe also the laptop.
Although it has some exciting launches lined up for 2024, will there be relief for Apple and its ongoing woes?
Apple did face multiple headwinds in 2023, and unfortunately, the year ahead promises more of the same. It remains to be seen how Apple navigates all of these headwinds as it moves forward. Take, for instance, the European Union Digital Market Act. The DMA looms large. It demands App Store openness, algorithmic transparency, as well as fairer fees, threatening Apple's control as well as revenues. That said, there are multiple variables at play, and it remains to be seen how all of this plays out in the time ahead.
While Apple faces several regulatory challenges across the globe, experts believe the American company is likely to maneuver its way out. With a course correction, of course. On the growth front, innovation is the way forward. Meanwhile, the growing middle class in India and other parts of the world will continue to fuel its growth.
And it wasn't just tech giant Apple. India was also a big draw for foreign investors last year. And thanks to the rising wealth, Indian investors too are increasingly investing in foreign shows. In the first half of 2023, FDI outflow to Dubai saw an increase of 65% compared to the same period last year. So what is driving increased Indian FDI into Dubai? Tariq Ahmed finds out.
From a small fishing village in the early 20th century, Dubai transformed to become a pivotal hub of international trade in the 21st century. A strategic geographical location and tax-friendly policies have helped Dubai emerge as one of the important international financial centers in the world. While Dubai's early growth was fueled by oil money, the Emirate has successfully managed to diversify its economy to encompass tourism, luxury, real estate, aviation, and financial services in the early 21st century. In 2018, oil's contribution to its GDP reportedly dwindled to less than 1%. The economic diversification of UAE and especially Dubai was mainly driven by foreign direct investment or FDI. In 2022, global FDI declined by 12%, but FDI inflow to UAE increased by 10% during the year compared to 2021, securing $23 billion. More than half of this sum, $12.8 billion, was invested in Dubai. India was the third biggest source of FDI for Dubai after the US and the UK in 2022, with a 12% contribution. According to international property consultant Vestian, in the first half of 2023, Indian FDI into Dubai surged to $335 million from $221 million during the same period in 2022. That is a 65% increase in 2023. In terms of number of projects, India remains the top country with investments in a total of 123 projects. Most of the FDI contribution from India to Dubai this year, almost 40%, went into IT services, and a majority of investments are focused greenfield projects. Apart from FDI, the residential market of Dubai has been another major focus of Indian investors. Indian investors bought real estate properties worth more than $4 billion in Dubai in 2022. The Better Homes Residential Market Report of 2023 indicates Indians have become the largest real estate investors in the Dubai property market, surpassing the Britons in the September quarter of 2023. Pritha Jha of Pioneer Legal points out the major driver of increased Indian FDI into Dubai.
The numbers that you're quoting regarding 335 million having been invested within the first 6 months of 2023 itself, I think has a lot to do with the tax policy that was announced by the Indian government, where essentially the TCS for foreign remittances under the liberalized remittance scheme was increased. And that was to come into effect from July 1st. Essentially, that would have meant that anybody who is buying property in Dubai would have had to shell out as much as 15% more if they had bought it during the second half of the year. So why has investment gone up in the first 6 months? That is likely the most immediate cause, because obviously tax planning announcements meant that you had to do it in the first half.
Dubai is also the preferred destination of FDI outflows from India. Between 2020 and the first half of 2023, Indians have invested $1.6 billion in Dubai. The UAE government is targeting to double Dubai's GDP by 2033 to position itself as a global economic hub. Indian investors have been leveraging the dynamic real estate market and investor-friendly policies in Dubai. This positive trajectory reflects the mutually beneficial relationship between the two countries, further strengthened by the signing of the Comprehensive Economic Partnership Agreement or CEPA in 2022. Former economics professor of JNU, Bishwajit Dhar, believes the bilateral free trade agreement between India and UAE played a major role in the increased FDI outflow.
When two countries agree to do these kinds of deals, they actually show political commitment to increase their economic partnership or economic cooperation. And therefore, there is also a message to the business community, traders and investors, that this is going to be a safe place to do business with. Yeah. So there'll be, investment is not going to get sunk. There are investment guarantees, and there's proper protection available to investors should they want to invest in that partner country. Now, in my view, this is what is happening, that there is a kind of a guarantee provided by both the UAE and India.
The 20% tax deducted at source on foreign remittances became applicable from October 2023 for transactions above 7 lakh rupees. Economists believe that the liberalized remittance scheme contributed to the surge in FDI outflow from India to Dubai. The Comprehensive Economic Partnership Agreement has also bolstered confidence among Indian investors regarding the security and stability of their investments in Dubai.
Let us now see what is happening in India's mutual fund industry. In the first 11 months of 2023, fund assets soared by 19%. These gains were largely driven by mid and small cap equity mutual funds, where the former category saw inflows worth over 36,000 crore rupees during the period. By comparison, the large cap equity mutual fund category saw net outflow of about 2,700 crore rupees. But as valuations turn frothy in the broader markets, will the large cap MFs find their mojo back this year? Nikita Vashisht reports.
Domestic equity markets clocked their best annual returns in 2023 since 2017, where the benchmark indices surged up to 20%. But the year actually belonged to the mid and small cap stocks, where the Nifty Mid Cap Index soared 46% and the Small Cap Index zoomed 48% in 2023. The euphoria in the small ticket stocks also led to gigantic inflows into related mutual funds. The mid-cap equity fund category saw inflow of 21,156 crore rupees between April and November last year. On the other hand, the small-cap fund category saw inflow of 36,325 crore rupees, according to data by Association of Mutual Funds in India. By comparison, the large-cap funds saw outflow of nearly 2,700 crore rupees during the period.
We are clearly seeing signs of euphoria in mid and small cap space. The starting point for us as investor is above average valuation accompanied by a strong earning cycle. Valuation is in the comfort zone as far as large cap is concerned, but mid and small cap valuation leave little scope in terms of margin of safety.
At 27 times 1 year forward price to earnings, the Nifty Mid Cap 100 Index trades at 35% premium to its average valuation as against a less than 20% premium for the Nifty 50. Going ahead, analysts believe flows will tilt towards large cap funds in 2024.
The valuations are not in a very comfortable scenario. So most of the positives are already priced in and many stocks are trading much above their intrinsic value. So going with that, the valuations are quite reasonable in few pockets in those large cap bucket. See lower than historic average returns in those large cap category, whereas mid and small cap, there is hardly any upside left in that bucket.
According to Amphi data, the average 1 year return for 23 small cap funds stood at 32.7% till December 6, 2023. In contrast, 30 large cap funds delivered average 1 year returns of 15% and 28 mid cap funds 28% during the same period. Against this, how should investors adjust their portfolios?
Many of those small cap funds could be holding very large positions in certain names. So if that is the case, if we want to see a market reversal at some point, those funds could face fairly high. Apart from those macro-related risks, there could be other fund-related risks as well. So if you're invested in any of those funds, you have to be extremely cautious. A large cap could outperform the small and mid cap from a relative valuation perspective.
Against this backdrop, analysts say incremental investments could be done in a staggered way in large cap funds. On January 3, domestic manufacturing PMI data for December 2023 and global cues will guide the markets.
He's making plans for an early retirement. Business Standard.
After the mutual funds, let us now turn our gaze to foreign affairs. Iran is now part of a free trade zone spread across a vast Eurasian region. This trade pact is called Eurasian Economic Union and is being led by Russia. Kasturi Akhil has more on this pact.
The Eurasian Economic Union, or EEU, is a bloc of nations which include Russia, Belarus, Kazakhstan, Kyrgyzstan, and Armenia. And it added 6th member recently when Iran signed a free trade agreement. This agreement will become permanent and replace the earlier temporary pact that was in force since 2019. The new agreement will allow parties to conduct mutual trade, provide tariff benefits, and remove customs duties in exchange of goods. The previous deal led to an increase in mutual trade between Iran and EEU to $6.2 billion in 2022 from $2.4 billion in 2019. Essentially, the primary objective of the Eurasian Economic Union is to create a common market in the former Soviet region. After the dissolution of the Soviet Union in 1991, Russia pursued various integration projects for fostering economic partnership in former Soviet nations but was resisted by many like Ukraine. However, there were others that sought an economic union with Russia for political support, security assurance, and access to cheap energy. In 2009, the EU initiated the Eastern Partnership Policy to deepen EU economic relations with its neighboring post-Soviet states such as Armenia, Azerbaijan, Belarus, Georgia, Moldova, and Ukraine. However, Russia saw this as an intrusion into its sphere of dominance and sought to create an alternative economic bloc. Consequently, the Eurasian Customs Union, which later became Eurasian Economic Union, was founded by Russia, Belarus, and Kazakhstan. On 29 May 2014, the treaty establishing the EEU was signed, which came into force on 1 January 2015. The EEU has its own institutions, much like that of the European Union, like it has its own regulatory body, the Eurasian Economic Commission, situated in Moscow, and a court of the Eurasian Economic Union based in Minsk. Amongst all the member states, Russia is not only the largest member of the bloc but also the biggest trade partner with a share of 98% in 2022-23. The new deal signed on 25th December establishes a preferential regime for almost all trade between Russia and Iran. It will eliminate customs duties on almost 90% of goods and allow Russian businesses to save around 27 billion rubles or $294 million each year, Russian Economy Minister Maxim Reshetnikov has said.
The nation's trusted bank, SBI, the banker to every Indian.
Starting this month, India too will start trade negotiations with the Eurasian Economic Union bloc for a free trade deal. External Affairs Minister S. Jaishankar said this in December last year. Well, that's all we have for you today. For more news and analysis, please log on to business-standard.com. Thank you for watching.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.